Good morning, ladies and gentlemen. Thank you so much for joining us for our strategic update. I'm Sim Tshabalala, Chief Executive of the Standard Bank Group, and today my colleagues and I are going to share with you the ways in which we have rethought and restructured the group to make the business more efficient, more competitive, and more sustainable, and indeed better able to fulfill our purpose. I'd like to begin by outlining and summarizing our message. The fundamental question that we will be answering today is this: what do we do and what do we have that others don't have and can't do, and that will give you confidence that we will deliver our SPG 2025 ambition and achieve the financial goals that we will have announced today? Our answer, in essence, is this: that we have updated our strategic priorities and that we will do three things. We'll transform client experience, execute with excellence, and drive sustainable growth and value. The classic strategic aphorism is fortune favors the big battalions. This is certainly true in financial services, where scale has always mattered decisively, not least in Africa. And of course, scale advantages have been further reinforced as we enter the digital age. The Standard Bank Group has massive scale advantages arising from a number of things. First, our unparalleled strategic strength and legitimacy worldwide, continent-wide, and indeed here in South Africa, our home base and largest single market. Throughout Africa and the world, people and businesses know that they can trust us. Second, the number of corporate and personal clients and hence relationships that we have throughout Africa and worldwide. We're already the market leader in many segments, and deepening these relationships will enable us to grow revenues by way of product proliferation and cross-sell. Third, the number of strong partners and service providers we already have, including Amazon Web Services, Microsoft, and Salesforce. As for Salesforce, they are the world leader in client engagement platforms, and they are indeed the kernel of the way we will interact with our clients. Fourth, we have scale advantages from the number of fast-growing sectors in which we have strong expertise and the number of rapidly expanding economies on the African continent where we have local operations and where financial deepening and greater market penetration, particularly by way of new digital channels and partnerships, will drive revenue uplift. Our fifth set of scale advantages arises from our robust capital structure and vast financial resources, our large and increasingly efficient and hard and soft infrastructure, and our deeply skilled and experienced people. Indeed, the largest and strongest financial services team on the continent. Of course, scale comes with complexities. That being so, we have effected and bedded down major structural changes to optimize our endowments. These structural changes include taking Liberty private to complete our financial services offering. They include creating a range of new ecosystems and our client solutions line of business, which will enable us to produce and distribute products and services much more cost efficiently through more channels and on a larger scale. And they include deepening our partnerships with our major vendors, such as Salesforce, AWS, and Microsoft, in order to achieve better cost efficiency and to create new revenue streams by making better use of data and by offering a wider range of services. We reported to you on this new basis yesterday, and as you will have seen, we're already seeing growth in client numbers, improved customer experience, growth in revenues, and an improvement in operational leverage and capital efficiency. Accordingly, it stands to reason that we will successfully execute and deliver the ROE and other financial targets we are unveiling today. This is who we are today. We are a leading African financial services group. We are focused on serving our clients in an integrated and comprehensive way, meeting their needs rather than just selling products in isolation, using our digital capabilities. We state our purpose like this: Africa is our home. We drive her growth. This is key to understanding who we are and the choices that we make. We have an almost 160-year history of serving clients and supporting economic development in Africa. Having opened our doors as a merchant banker in September 1862 to serve the wool traders of the Eastern Cape province of South Africa. We have been building our Africa-wide franchise since the late 1980s. We are now present in all of the largest and most dynamic markets in sub-Saharan Africa. We are the largest financial services group in Africa, and we are, for example, the leading home loan provider and global markets business in South Africa, the largest retail and wholesale bank in Uganda, and the largest asset manager in Nigeria. We're also present in the major international financial centers so that we can link Africa to the wider world and support our African franchise. The scale and reach of our group is unique. It's unique in Africa, as is our strategic partnership with the world's largest bank, the Industrial and Commercial Bank of China. Our client base is large and very diverse, ranging from individual clients with the simplest of financial services needs to small and medium-sized businesses, substantial commercial clients, high net worth families, and very large domestic, regional, and multinational corporates, which require the most complex and sophisticated of financial services and professional advice. Whoever our clients may be, we aim to serve them all with consistent excellence, drawing on a combination of digital efficiency and human empathy. We have confronted a number of shortcomings and challenges over the last decade. This is a sobering list. Loss of market share in retail banking in South Africa, a costly core banking modernization in South Africa, and slow progress on improving efficiency, losses in ICBCS, and insufficient integration with Liberty. We can equally say that we have learned valuable lessons and made good progress in addressing these challenges, as you will see today. For instance, the consumer and high net worth business is growing again. Modern digital systems are in place, which will enable us to be a lot more efficient. ICBCS is well on track to full integration with ICBC. And here, we remain focused on exiting our 40% stake as soon as is feasible. And we've announced our intention to buy out Liberty's minority shareholders in order to simplify and grow our combined banking, insurance, and asset management capabilities to create something quite special and unbeatable. We intend to draw Liberty's formidable capabilities more closely into the wider Standard Bank Group. Our proposed buyout will be by way of a share and cash offer. Once the transaction is completed, Liberty minority shareholders will hold approximately 3.5% of Standard Bank's shares. The combination of Standard Bank and Liberty will produce greater revenues, accompanied by better operational and capital performance than if the two had remained as they are now. We expect Liberty to be delisted in the first quarter of next year. The rationale for this transaction has several elements. Full integration of Liberty products and services into the group will allow us to deliver a more comprehensive and more tightly integrated set of financial and related services to our customers. The transaction also represents a significant simplification of the group structure, streamlining governance and improving flexibility, and creating attractive revenue-generating opportunities particularly for our client solutions line of business. We are confident that the transaction will deliver sustainable growth and value by aligning and leveraging our strengths, enhancing client value, delivering on the refreshed Liberty and Standard Bank strategies, and enabling us to retain key talent and to protect intellectual property. As recently as the 1990s, being an Africa-focused financial services group might have seemed quixotic. This decision turned out to demonstrate excellent strategic foresight on the part of previous Standard Bank management. Sub-Saharan Africa as a whole has been growing fast and steadily since the turn of the millennium, driven by favorable demographics, urbanization, and digitization. Indeed, some countries, such as Ethiopia, Kenya, and Ghana, have been radically transformed over the last 20 years from among the poorest places in the world to among the most dynamic. Our home base and largest market, South Africa, has had a much more difficult decade than the continent as a whole. We are, however, encouraged by the pace of the South African economy's recovery from the pandemic and by the structural reforms currently underway. We're hopeful that South Africa's economic performance will improve steadily over the medium and longer terms. We're confident that being Africa and South Africa's leading financial services group is going to continue to be strategically advantageous over the medium and longer term. Over the decades to come, we expect that Africa's population will continue to grow quickly and that it will continue to become healthier, wealthier, better educated, more urbanized, more digitally connected, and more productive. It follows that we also expect trade and investment flows between Africa and the wider world to continue to increase, accelerated by the benefits of the African Continental Free Trade Area. These trends will, of course, have strongly positive effects on demand for financial services. On the retail side, Africans will want a wider range of financial services as their incomes increase and will want these services to be delivered online. Given our plans with Liberty, it's relevant to note that demand for structured savings and insurance increases particularly rapidly as national income per head rises into the middle income range. On the wholesale side, rapid growth will see increased demand for lending, equity, payment, transactional, advisory, and risk management products and services in support of new infrastructure, new productive capacity, and new patterns of trade, all increasingly shaped by sustainability imperatives. Our clients' expectations are increasingly set by businesses like Amazon and Alibaba, and by new digital entrants to financial services. And the growing presence and ambitions of telcos and fintechs in African financial services has certainly not escaped our notice. I'll say a bit more about our relationship with fintechs shortly. In order to compete and win in the dawning age of digital finance in Africa, we will ensure that our client service will be just as stable, just as personalized, just as convenient, and just as user-friendly as that provided by, for example, MTN, Safaricom, or Alibaba and Amazon, for that matter. As a financial services business, we will of course also continue to comply with the demanding, complex, and rapidly changing regulatory requirements that characterize our industry. And we will continue to invest heavily and work hard to remain secure against the intense cyber attacks faced by all financial services firms. While the economic winds are very favorable, it's certainly not going to be plain sailing in a fast-changing, highly competitive, and highly regulated market. As I've said, we do think we have some hard-to-replicate advantages that will enable us to keep growing our market shares and revenues, including our large and well-balanced portfolio and our strong risk management skills. But we are very far from complacent. Indeed, complacency, maintaining the status quo, if you like, would be too risky. We believe that in a no-change scenario, we would lose clients, our revenues would flatten, or worse, decline, efficiency would deteriorate, and returns would fall. In the worst case, we'd end up as a back office with very little pricing power and permanently lower ROE. This is not an acceptable outcome. We are therefore embracing change in order to ensure that we continue to grasp the opportunities, compete successfully, win in our markets, and offer improved returns to our investors. We have made large changes to how we are organized to serve our clients. We have reconfigured the relationship between the group as a whole and our countries in order to enable them to respond more rapidly and more precisely to our clients' local needs. Over the same period, we've worked hard to introduce new ways of working, creating a work culture and habits that emphasize speed, suppleness, and collaboration. As from the beginning of this year, we are no longer organized into two business units, corporate and investment banking and personal and business banking. We're now primarily organized into three client segments: consumer and high net worth clients, business and commercial clients, and wholesale clients. Each of the three client segments is equally supported by our client solutions, engineering, and innovation capabilities. We have done this for three reasons. First, to provide our clients, from individuals to major corporations, with a comprehensive range of financial services in a seamless way without expecting them to navigate our internal complexities. Second, to reduce time and cost to serve. Third, to enable us to innovate much more quickly and efficiently in the service of our clients, especially by creating new partnerships and new services. In order to compete successfully, it is essential that we remain relevant to our clients. We are, therefore, building out from our solid foundation in traditional financial services to meet our clients where they are, on the digital platforms where they are shopping, socializing, and doing business. As a driver of some ecosystems, we will create ecosystems, be the market maker, as it were. As a contributor to ecosystems, we will lend our skills and capacities to ecosystems in which we can be useful, but not absolutely central, such as education and healthcare. To put the same point more concretely, when we're talking about driving or leading an ecosystem, we say that we don't just want to be the shop, we want to be the mall. We want to be a single convenient destination where people and firms can find the products and services they need quickly and conveniently. Equally, as an ecosystem participant, we aim to be a particularly attractive shop in somebody else's mall. So, for example, to start creating the Standard Bank virtual mall, we don't just provide trade finance. In addition to credit and foreign exchange services, we offer Africa's importers and exporters introductions to trustworthy trade partners and logistics partners. And we provide assistance with navigating all the associated red tape. We call the service Trade Suite. We have chosen to prioritize 10 ecosystems. 5 where we can play a leading role, such as international trade and home services, and 5 in which we can make a significant contribution, such as supporting healthcare and providing mobility. Our 10 chosen ecosystems are all adjacent to traditional finance, and all will make a significant contribution to improving our clients' lives and businesses, and over time, our group's revenues and earnings. We estimate that together, these 10 ecosystems will enable us to access pools of value that are worth collectively over $1 trillion, which is a remarkably large number and a very big prize. We're neither daunted nor dazzled, and we are approaching these markets very systematically, starting by building and launching a range of solutions with close links to our traditional financial services businesses. These include the services I have already mentioned, and also Look-See in the home services ecosystem, Shift in the global citizens ecosystem, and Power Pulse in the energy ecosystem. We have a clear plan to build scale and monetize these initiatives, and they should already be making a valuable contribution to the group by 2025, although the full benefits will be felt beyond 2025. We expect that the Standard Bank Group will always remain predominantly a financial services business. But we also expect that these new services will make a substantial contribution to improving client satisfaction and loyalty. We expect that we will increase our share of wallet, counteract a margin compression that we are seeing in financial services, and hence diversify and grow our revenues and earnings. Our 3 strategic priorities create the framework within which we work. Everything we do, whether traditional or innovative, will further these 3 priorities. This narrows our focus and therefore increases the probability that we will execute fast and accurately. First, we will transform client experience using digital technology amplified by the human touch. We aim to understand our clients as deeply and empathetically as we can, and then use our human skills and digital capabilities to help meet their needs and enable them to achieve their goals. Day to day, we will defend the client franchise, while at the same time capturing new opportunities to grow. Our 3 client segment heads, Funeka, David, and Kenny, will explain how this translates into their individual strategies and focus areas. Second, we will execute with excellence, simply defined as delivering innovative and cost-effective products and services ourselves and in partnership with others. Margaret and Alpheus will unpack this in more detail after the break. And third, we will drive sustainable growth and value. Here we use sustainable to mean long-term and mean environmentally and socially sustainable. For us, these 2 concepts are tightly and indeed necessarily linked to each other. David will cover our approach to ESG and the positive impact we strive to deliver. Arno will speak about resource allocation and how everything comes together in the financial targets we announced earlier today. The Standard Bank Group has been criticized in the past for lacking focus, or to be more charitable, for trying to be all things to all people. Whatever we think of those views, we must admit that there was perhaps a grain of truth in the criticism. We have removed that grain. As you will shortly hear from Funeka, David, and Kenny, each of the client segments has developed a set of clearly differentiated and sharply focused priorities. Consumer and high net worth, for example, has very specific plans to grow market share rapidly and efficiently in the mass markets in South Africa and Africa regions. Business and commercial will be leveraging its strength in trade finance, and wholesale will continue to build its market-leading sustainable finance offering. Let me emphasize, these are just examples. My colleagues will be presenting their detailed strategies shortly. As you will see, each strategy has two things in common. Each segment will maintain and protect their strengths, and each is building new ecosystems in a few focused and clearly identified areas to meet the expanding needs of our clients. Client Solutions will focus on delivering innovative products and services that are standardized, connectable, and cost-effective. In a word, modular, so that they can be efficiently scaled across our client segments and countries, and also sold to other companies, creating new opportunities and new revenue streams. As we see it, in a digital and networked economy, it is old-fashioned and inefficient to be squeamish about competing in some contexts and partnering in others. After all, we already do this as a matter of course in correspondent banking. We look forward to a time when our services are sold on other businesses' platforms, and when our rivals' products jostle for clients in our virtual mall alongside our own, especially since many of those rival products will actually be provided by us as white-labeled services. An essential precondition for being a winning business is to have the right infrastructure. That's the job of engineering. Engineering brings together all the infrastructure we use to deliver the group services. Their responsibilities include maintaining our physical infrastructure, running an efficient, stable, and robust and secure IT system, and providing comprehensive data management and analytics and monetization capabilities. Our engineering capability equally focuses on keeping our clients' information and assets secure, on developing a single client engagement layer, on simplifying and automating processes, and on enabling integration and partnerships. Alpheus will unpack this in more detail later. We intend to keep accelerating the pace of disciplined and successful innovation. To this end, we have created a specialized innovation capability. We don't believe in failing fast. Our goal is to learn fast and succeed often. To ensure this, the specialized innovation team promotes a culture of innovation across the organization, provides expertise and skills to amplify and support innovation, ensures rigor and robust processes for the prioritization and development of new business models across the group, and importantly, pursues its own innovations, which we want to be disruptive and to focus on completely new markets for the group. We have a small, closely managed portfolio of investments which contributes to the competitive disruptiveness of the group and enhances our offering to our clients by facilitating partnerships with technology providers and by undertaking acquisitions when that's appropriate. We have also formed a partnership with Founders Factory Africa, which both creates new startups and helps to scale existing ones. To achieve our ambition, our people are learning to think and act differently, and we are encouraging all our colleagues to develop new and more relevant skills. We have, for example, created personalized online learning programs for digital skills with excellent take-up by our people. These include courses on cloud, data, artificial intelligence, and machine learning. We're also working with our strategic partners, Microsoft, Amazon Web Services, and Salesforce, to launch a skills academy to develop critical engineering skills across Africa. For several years now, we have been explicitly committed to promoting sustainable and inclusive development. We are therefore committed to considering the environmental and social impacts of our decisions and actions very carefully, taking all our stakeholders' views and preferences fully into account. We'll continue to balance these perspectives, guided by our purpose, by our membership of the UN Principles for responsible banking, by our commitment to advancing the UN Sustainable Development Goals, and by the Paris Agreement's target to limit warming to well below 2 degrees above pre-industrial levels in the context of a just transition. In line with global best practice, we will continue to increase the transparency of our decision-making and the detail of our ESG reporting. We will publish our climate strategy and targets in the next reporting cycle. One thing that doesn't change about the Standard Bank Group is our commitment to world-class governance and risk management. This is embedded in the way we do things, and ESG risk management is no different. Our approach, therefore, is built on best practice. Our processes are thorough and require multi-stage approvals. We're tightly focused on efficient investment. We will preserve the strong franchises we have. We have a strong bias towards capital efficient and high margin growth. We will invest in fast-growing geographies and segments where the return on investment is clear and attractive, and we will ensure that our new businesses reach their efficient scales. The financial targets that we're announcing today are the most important goals. These targets are challenging, but they are realistic, and we are committed to achieving them. By protecting and growing our traditional markets, and by finding new ones, it is our intention to increase our revenue by 7 to 9% a year. As the effects of the pandemic recede, we will keep our credit loss ratio in the range between 70 and 100 basis points. As I said at the start, we've had less success with our operational efficiency. In the past, we have in fact been highly disciplined, but within expensive structures. In our revised structure, we will be able to generate positive jaws, and our cost-to-income ratio will trend towards 50%. We will keep our Common Equity Tier 1 capital ratio prudently above 11%. All this culminates in our new post-pandemic ROE target range of between 17 and 20%. In summary, we're feeling confident and energized. We know exactly what we're going to do. We're sure we're going to be able to meet these targets. But don't just take my word for it. It's now my great pleasure to hand over to our 3 client segment chief executives, Funeka Monjane, David Hodnett, and Kenny Fihla, to talk in more detail about what we're doing and about the exciting opportunities we're seeing going forward.